Welcome to the Daily Drawdown, where rising yields, AI spending, and frozen housing set the tone. The biggest pressure point right now is simple. Too much capital is being demanded at once. Governments need to refinance, AI needs to build, and markets are starting to ask what price clears all of it. The bond story is no longer just a rate story, it is a supply story. U.S. weekly T-bill auctions are now running around $400 billion, up roughly 300% from 2011, and about 23% of outstanding marketable U.S. debt now sits in bills. That leaves a lot of refinancing exposed if rates stay high. At the same time, long yields have reset higher across the developed world. The U.S. 30-year is around 5.3%. The 10-year is pressing the 4.7 to 4.8 range. Japan's 10-year is near multi-decade highs around 3%, and Germany and France are also at levels not seen in 15 to 20 years. Why it matters is straightforward. The zero-rate era is over. Interest expense is becoming fiscal policy, foreign demand is less dependable, and sovereign borrowers are now competing with private borrowers for the same pool of capital. In the U.S., debt is above $40 trillion, and annual interest costs are already over $1 trillion. If long rates stay elevated, that cost structure hardens. What to watch next is whether the 10-year can push through 5% and stay there. Markets can tolerate high yields better than fast yields. Speed is the risk. The threshold investors keep circling is a 10-year yield near 5%, and in more stressed scenarios, a 30-year moving towards 6%. If yields touch those levels briefly, equities may absorb it. If they live there, valuation compression becomes much more serious, especially in long-duration growth names. That is where deleveraging, factor rotation, and broader corrections can start feeding on themselves. The key variable is not just the level. It is whether the move is aggressive and sustained. This is where the AI boom becomes a macro issue. Estimates for AI-related capital needs over the next year or two are running around $1.25 to $1.5 trillion. Hyperscalers, chip firms, and data center operators are issuing debt and securitizations at a scale large enough to matter for the whole market. That private demand may not back off quickly because many issuers believe the returns justify higher financing costs. If you think a project can earn 20 to 30%, a higher coupon is annoying, not disqualifying. The catch is sustainability. Investor sentiment is starting to lean more toward balance sheet repair than endless capex, and the bottleneck is not just money. It is power, permitting, water, and local resistance. Less than a quarter of planned data center gigawatts were reportedly under construction. If deployment lags, chip backlogs, and revenue assumptions become more fragile, especially in memory and other high-beta semiconductor names. So the watch item here is whether physical build-out catches up to financial commitments. If not, the market may start repricing AI hardware faster than AI software. On the commercial side, Anthropic's reported growth is the kind that changes the conversation. Reported annualized revenue was said to be around $65 billion by late July, with quarterly revenue around $11.5 billion, putting it in direct commercial competition with OpenAI by headline scale, even if accounting differences matter. That strengthens the case for a possible IPO, but it also raises the bar for scrutiny. Investors will want to see margins, durability, pricing power against open-source pressure, and whether growth slows sharply as revenues get much larger. The broader point is concentration. A handful of firms are pulling in capital, compute, and customer demand at extraordinary scale, and that concentrates both upside and market risk. The most important legal story in tech is Meta's child safety trial. A coalition of states argues that features like infinite scroll, autoplay, and notifications were designed to drive excessive youth engagement while collecting youth data. The states are seeking roughly $200 billion. The real risk is not only monetary product changes, data deletion, or limits on models trained on youth data could hit Meta's ad engine and product roadmap in ways a fine alone would not. That makes this worth watching well beyond Meta. If courts start treating addictive design and youth data use as remedy-worthy product issues, the precedent could spread across consumer internet platforms. housing still looks frozen, not healed. Existing home sales are hovering near 4 million annualized instead of the roughly 5.5 million that would look normal. Pending sales slipped again in July, and single-family starts were down sharply month over month and year over year. Mortgage rates near 6.75% and the rate lock effect are still choking turnover. Owners with cheap pandemic mortgages are staying put, which holds back listings as well as transactions. The split inside housing is important. Affluent-focused builders like Toll Brothers are still holding margins and backlog much better than mass-market builders because higher-income buyers remain more insulated. That lines up with the broader consumer picture. Retail sales are still up year over year. Delinquency trends are not screaming stress. Unemployment is low, and Home Depot just posted another better-than-expected quarter with improving comp momentum. So the consumer is not rolling over broadly, but it is still K-shaped. Higher income households are carrying more of the load, and housing probably stays stuck until mortgage rates fall enough to unlock both demand and supply. Two tactical rotations stand out. First, refiners and fuel marketers have run hard and look historically extended, with some names around 40% above their 150-day moving averages. Prior episodes like that were often followed by pullbacks over the next 3 to 6 months. Integrated energy is a different case. Exxon and Chevron still screen better on free cash flow yield and balance sheet resilience, so the trade there is trim refiners, not abandon energy. Second, financials have had a long rally on a steeper curve and stronger fee income, but the group also looks stretched. If yields stay high, investors may rotate within financials toward insurers, exchanges, and sturdier balance sheets rather than chase the most rate-sensitive names. A few smaller but useful signals. Robinhood users turned into net sellers for 2 straight weeks at the end of July, which is notable because that base is usually a steady bid that hints at selective profit-taking and more caution in retail flows. Copper remains one of the cleaner structural demand stories. BHP sees demand rising from roughly 34 million tons today to around 50 million by 2050, driven by electrification, AI infrastructure, and India. That keeps copper strategically important even if growth scares create short-term volatility. And in healthcare, GLP-1 pricing keeps collapsing as competition and compounding pressure the market. That matters for margins, but it also broadens access and strengthens the case for AI-enabled adherence platforms if lower drug costs make the full care stack easier to scale. The through line today is tighter capital, higher thresholds, and less room for weak assumptions. That is the setup markets have to price. Now this is the daily drawdown. This episode was generated by Podkey. Create your own at podkey.fm.